Dear students, in this video we will be discussing the basic and major journal entries which are important in our day-to-day business transactions. So here, the beginning with the first transaction, which is relating to the capital account. Sahil started his business with cash, furniture and a motorbike worth rupees 10,000, 20,000 and 30,000 respectively. When they are saying the word respectively, it means that we have to consider these three items, cash, furniture and motorbike, with the amount which is given in a series. Okay, here you can see that one by one. Cash is equal to 10,000, furniture is equal to 20,000 and motorbike is equal to 30,000, that is respectively. Okay, so that we have to understand. So here Sahil is not starting the business only with the cash. Here he is starting with furniture, motorbike also. So when someone is starting a business, it is not necessarily mean that the person is investing the cash only. He may start a business with any other asset also. So here when Sahil is starting a business with cash, furniture and motorbike, so that three items should be debited. Why? See, cash is an asset, furniture is also an asset, motorbike is also an asset. So cash is a current asset, furniture and motorbike are fixed assets. So irrespective of current or fixed asset, here all these three items are asset which are being invested in the business by Sahil, that should be debited in the business, because in the business all these items are being in brought. Okay, brought. So in business these items are increasing. Cash is increasing in the business, furniture is increasing, motorbike is increasing in the business. So these items are increasing in the business, means assets are increasing in the business. So uh, that should be debited as per the modern rules of accounting. When the assets in the business increases, we have to debit those items and credit that to a capital account. Capital in the business is increasing, so when capital increases, that should be credited. So here cash account debtors to, furniture account debtors to, motorbike account debtors to, capital account. Here cash is 10,000, furniture is 20,000, motorbike is 30,000 and the total of all these three is capital account, that is 60,000. The narration for this is being business started with cash, furniture and motorbike. The next transaction is cash and goods are withdrawn from the office for personal use, that is 500 and 1000 respectively. Here they are saying that the owner of the business has withdrawn the money for his personal use. That means that this is a drawings. When the owner of the business withdraws the money, means he is taking the money from the business for his personal use, that is withdrawings. Okay, so when he is drawing the money from the business, it is drawings are increasing. Okay, so as per the modern rules, when drawings are increasing, okay, you remember that dealer concept, DEALER, D for drawings, E for expenses, A for asset. If drawings, expenses and assets are increasing, that should be debited. If those are decreasing, that should be credited. Here drawings is increasing here, as the person is drawing the money from the business. So drawings is increasing, but in the business cash is decreasing because he has taken the money. Okay, he has taken the money, that is decreasing. Also he has taken the money, he has taken the goods they have specified here, he has taken the goods. So it is hitting into a purchases account. Purchases, what the purchases of goods were done. Okay, so assume that there were some amount of goods already existing in the business, out of which 1000 worth of goods he has drawn for his personal use. So that is why it is hitting the purchase account. So here we have to write a entry like drawings accounts debited, that the drawings account debtors to, debited is combination of both the amount. Okay, add the 500 rupees and 1000 rupees which he has drawn in the form of cash and goods. that we have to write, and the narration is being cash 500 and goods of 1000 withdrawn for personal use. You can write the narration in your own words, not necessary as whatever they have mentioned here. Next, rent paid in cash rupees 5000. So here rent is paid in a cash. This is a very easy transaction. Rent is paid, that rent is an expenses for a business and it is paid in the form of cash. Obviously when we pay the money to someone in the form of cash, cash is reducing, that should be credited, and rent is a form of expenses when the expenses are increasing. Okay, drawings, expenses and asset, DEA. Okay, when the expenses are increasing, that we have to debit. So here rent account debtors to cash account, being rent paid in cash, amount is 5000 to be debited in a rent account and 5000 to be credited in a cash account, because cash is reducing here in a business. Next, commission received in cash. Commission received in cash. Now amount is received here. LER, liabilities, equity or capital, and income or revenue or income, right? So here commission is received is a form of income to the business. So here when something is being received, that is revenue or income is received, if it is increasing in a business, that should be credited. If it is decreasing in a business, that should be debited. So here when we are receiving the money, it is increasing in the business, so that should be credited. When it is increasing in the business, that should be credited. Cash in the business is increasing as we received that money in the business, so cash is an asset. When asset is increasing, that should be debited. So here the transaction is cash account debtors to commission received or commission account. So here why they have specifically said commission received, because the amount is received here. If you there may be chances that commission paid kind of transaction may arise, that's why they have specifically said here commission received account. You can also write commission account. Okay, so being commission of rupees 10,000 received in cash. So here 10,000 amount received in cash should be debited and 10,000 should be credited to commission received account. So these are about the normal transaction. Now we will go with the goods related transaction. Here you can see goods purchased in cash. It is simple. Goods purchased in cash means like I have already said, business goods are being purchased by paying the cash, that we know that. Okay, that time purchase account debtors to cash account, that here you can see that purchase account debtors to cash account, being goods purchased in cash. So here that is business goods are purchased in cash. Purchases is an expense and cash is an asset. Purchases is an expense, cash is an asset. When expenses increases, that should be debited. When the asset decreases, when we are purchasing something, we are paying the cash, asset decreases, that should be credited. So the amount of 25,000 rupees is debited here for purchases and 25,000 rupees is credited here for cash. That is a transaction, being goods purchased in cash. Now what they are saying, goods worth 5,000 were given as a donation. So see here, worth rupees 25,000 goods were purchased here. Okay, that is business goods only. Out of that 25,000 worth rupees goods, 5,000 rupees worth goods are donated. So when it is donated, we have to show it in a purchase account that we purchased for 25,000 worth of goods. Now out of 25,000, 5,000 rupees goods are donated. The balance is 20,000, like that we have to show it in a ledger books, right? So when you are preparing the ledger books after this journal entries and everything, so there we have to show in a purchase account that we purchased 25,000 worth of goods and 5,000 worth of goods are donated and remaining is 20,000 worth of goods, like that we have to show. So here you have to understand that donation is done, it is a form of expenses or loss. When expenses or loss are increasing, okay, in a business that should be debited, and purchases here are reducing. Purchases sorry, that is purchase is again an expense, but here whatever the goods we already had, that we are given as in the form of donation, there we have to credit the amount. So here the transaction is donation account data to purchase account. So 5000 worth of amount is 5000 worth of amount is put it in a donation, have put it in our donation account, and the remaining the same 5000 is reduced in a purchase account, to show that out of 25,000 rupees of goods, only 5,000 rupees of goods are donated and 20,000 worth of goods are remaining in a business. That kind of transaction will be shown in the ledger books. So next, drawings account. Drawings account, why it is drawings account here? Let's see what is the transaction. Seventh transaction here, goods worth rupees 1000 taken away for personal use by the proprietor. So see here, 25,000 worth of goods were brought, 5,000 worth of goods were donated, and 1,000 worth of goods are now taken away by the proprietor for his personal use. Means it is a drawings account. And which is the other account which is being hit here? It is a purchase account again. In the purchase account, first we brought 25,000 worth of goods, 5,000 worth of goods we donated, so we reduced it in a purchase account. Now 1,000 worth of goods are drawn by the owner for his personal use, again that should be reduced in a purchase account. And that's why here drawings account data to purchase account. Next is next transaction, eighth one is that goods lost by the fire. So here out all after doing this, all this, whatever the goods were left, out of that goods 2,500 worth of goods were lost in fire. So here we have to show that also what happened to those goods. Lost by fire is again an loss for a business. Expenses or losses for the business. If here expenses or losses are increasing for the business, that's why we have to show it in a debit. This one, to purchases is here again, that is again a form of expenses here, that have to be shown in a credit form, because we have to show that out of 25,000, if you observe here, first we brought a goods worth, purchased the goods worth of 25,000, out of which 5,000 rupees was worth of goods were donated, that is 20,000 worth of goods is left, out of which again 1,000 goods of 1,000 worth of goods are drawn by the business owner, that is 19,000 worth of goods is left. Out again 2,500 worth of goods is lost by fire. Now that means that around 16,500 amount of goods is left, right? To show that we are crediting the transactions here to purchase account. Okay, so when we bought the goods, we debited that to 25,000, but when we donated it, or we drawn it, or we lost by fire, we credited that to purchase account. So that is how it hits in a liabilities, in a ledger accounts. Next, goods sold to Nupur on credit worth rupees 2,000. It is easy. Here two accounts are being hit, Nupur account and sales account. Why Nupur account? Nupur account is because here it is sold in the form of credit, right? So Nupur account is being hit, and also the sales account. Sales account is being hit because we are selling, and this is a revenue item. When we are selling the goods, revenue is coming. So say when revenue is generated, revenue in the business is increasing, that should be credited as per our modern rules of accounting dealer concept. If revenue is increasing, that should be credited. If this credit Nupur account, he is now Nupur is a creditor to the business, creditor is a liability. When liability is increasing, that should be debited. Here Nupur accounts debtors to debtor 2,000 rupees, to sales account of 2,000 rupees. Narration is being goods sold to Nupur on credit. Next, goods sold to Gaurav for cash. So here you can see that cash account debtors to sales account. Here it's simple that goods are sold in the to Gaurav, but cash is received. So here we are using a cash account, not we are not using Gaurav name here because there is nothing left to be paid to Gaurav. Cash is already paid. When we pay the in the form of cash, that we have to show it in a cash account only. Not if we use the word Gaurav here, the name of Gaurav person here, it will be like a credit transaction. Then we have, it shows that we have left to be paid to Gaurav. So it should not be the name of the person or an artificial person. Not if we have paid it in the form of cash, that should be written as cash account data to sales account, being goods sold for cash. Next, next transactions, goods purchased worth rupees 2000 from Shubham were returned. Here, see, this is a twist in the business. So what happened? Goods were purchased from Shubham worth rupees 2000, but what we received, what we purchased, is now being returned back to him because of any reason. We return back, that we call it as return outwards or purchase returns. Okay, return outwards or purchase returns out account, we call it. Okay, so here, if in case when we purchase the goods, okay, when we purchase the goods, it is simple that the purchase account data to cash account or something like that, right? But here, as we have returned the goods back, we are preparing a contra entry. Contra entry means opposite entry of the normal entry. Okay, normal entry is if goods purchased worth rupees 2000 from Shubham, could have been a purchase account data to Shubham account something. Okay, but here it is returned back. So here, that's why when it is returned back, the entry is ulta, so opposite. So Shubham account data to purchase account is the entry here, being goods returned back worth rupees 2000. So here we are reducing the goods of 2000 in a purchase account and debiting that in the Shubham account, considering that he has to pay us money back. He has not yet paid karke. Okay, so next, goods sold to Nupur were returned worth rupees 1000. What we had sold to Nupur, now worth rupees 1000 goods are sold, sent back by her to us. Okay, now that is sales returns account. What we had sold is coming back to us. So sales return accounts data to Nupur account. Here sales return is what we sold is coming back to us. She has not kept that goods with her. She is sending few goods of worth rupees 1000 back to us. Okay, that is sales return account. Sales return, because sales is a revenue item, but here sales return, when sales is returning, revenue is reducing. Okay, so as per the dealer concept, if the revenue is reducing, that should be uh, credited. But here it is like sales is a revenue item, but when we are receiving it, it is like a form of loss for us. For when we are receiving it, it is a form of loss for us, hence we are debiting it. And in a Nupur account where she had to pay us some amount, right, we are crediting that to show that she doesn't need to pay that much of amount anymore. In the previous transaction somewhere, let's see here, you can see that Nupur account, she purchased goods from us worth rupees 2000, right? Nupur account data to sale account. Now we are creating an entry opposing to that, that is sales return account data to Nupur account. So here goods are returned back to us. Okay, goods are coming to us, so we are debiting that, and in the Nupur account we are crediting that 1000 rupees. Next, cash is deposited in the bank worth rupees 10,000. So it is easy, as you all know that there are two accounts being hit here, cash account and the bank account. When the cash is reducing in our hand, that is why we are crediting that. In bank, cash is increasing, hence that we are debiting that item. Bank account data to cash account. Next, cash is withdrawn from the bank. Now again it is simple. From the bank we have drawn the money for business use. They have not specifically said that that is for personal use. If it is for personal use, that could have been which account? Drawings account. but here it is not for personal use, it is assumed that it is for a business use only. So cash account data to bank account. So cash is increasing in the business, but in the bank amount is reducing because we have withdrawn that. So cash account data to bank account. So next is the proprietor withdrew cash from the bank for his personal use. Here you can see that now the proprietor has drawn some personal for amount worth rupees 5,000 from the bank for personal use. So here it is hitting the drawings account, right? Drawings are increasing, that's why we have debited here. Bank, the amount is decreasing. Bank is an asset, okay? So cash in the bank is decreasing, that's why we are crediting that. So being cash withdrawn from the bank for personal use. Next is 1st April 2022, a check of 11,000 was received by Bichai. So here you can see on 1st April 2022, a check of 11,000 was received by Bichai. That means on that particular date, a check in the hand has come. We are not just because they have mentioned here check is received, it doesn't mean that we are specifying the bank account here, okay? Check is just received, it has not yet been deposited to the bank, okay? So here check is received, that's why we are specifically saying check in the hand is increasing, that's why it is an asset, okay? Check in the hand, cash in the hand, all these items are an asset for the business, so it is increasing in the business, we are debiting that. So received from Vijay, so because still the amount is not yet converted into a cash, right? Check is still in our hand, we have not converted that into a cash by depositing it in a bank account, okay? So that's why we have specified there as a Vijay account. Personal or artificial person or in natural person name should be mentioned there. So check in the hand, debtors to Vijay account, being payment received through check from Vijay. So next there may be a chance that that check may get dishonor, that check may get accepted, or whatever the situation means. Dishonor means rejection, okay? Anything may happen, that's why still we are using the word here Vijay account. Next, the check received from Vijay was sent to the bank. Now bank account data to check in hand account. So next, that means that it was sent to the bank, it has gone to the bank. Now we don't have a check in our hand, that means in our hand the check is reducing, that means asset is reducing, that is credited. In bank, asset is increasing, that is in bank account is an asset that is increasing, that's why it is debited. So next is check received from Vijay was endorsed to Nupur. So what is endorsement? Endorsement is transfer of a check from one person to other person. So instead of sending it to bank, assume that here we did not